Let's talk about solvency ratios. So we talked about short-term debt, right? So end of the day, can I pay my credit card bills? Can I pay my mortgage this year? Then long-term, can I pay my mortgage in the long term? Can I pay my student loans? All those questions are more of a solvency questions from a personal perspective. From a company perspective, we talked about the construction company, right? It doesn't matter if the construction company can pay their current bills if they owe $1 billion and they can only sell their buildings for 500 million, which is what happened in the last recession, which that collapsed the economy, right? Is these companies were no longer solvent, and then the banks had to eat the price, and then eventually we all had to eat it through taxes. So solvency ratios. What we're going to be focused mainly is debt ratio and equity ratio. I want us to learn these other two as well, debt to equity and times interest earned. So we're going to use these numbers, but you can just go back to them for examples. So the debt and equity ratios. The debt ratio expresses total liabilities as a percent of assets, and the equity ratio expresses total equity as a percent of assets. Relatively easy, so straightforward, right? Hopefully easy to remember. Debt ratio is just total debt to assets. Equity is total equity to assets. So total liabilities, and then debt to equity is total liabilities over total equity. And so this measures how much of the assets is going to be owed pretty much by the investors. So the larger the debt to equity is, the worse it is, theoretically, right? A lot of people think of it as worse for small business. Know, though, that some companies, like in this marketplace, when debt goes down, sometimes you want a higher debt to equity ratio because equity might be more expensive. Bringing on a partner might be more expensive than taking a 1 or 2% loan. So here we go. Total liabilities, total equity, total liabilities and equity. So the debt ratio is just this 112,000 divided by 346,390. Gets our 32.3%. This debt ratio is just telling us that for all of our assets, 32% of those assets are financed by debt through an external creditor. Then we can find that 390 divided by the 346,390. 67.7% of this is financed by equity. So investors, right? So 32% is financed by banks. You can think about it, creditors, someone given a loan, and the rest is financed by investors. It could be you if you're a sole investor or a bunch of shareholders. Depends, and this will be more in your finance, if debt is more expensive or equity is more expensive. If you're a sole owner, you generally want to have as much equity as you can. If you're multiple owners, it might make more sense. You don't want the other owners to have as much. It might make more sense to bring on debt. And this tells us how quickly, how solvent we are as a company. If the creditors have more than the investors, then the creditors might be able to declare bankruptcy, say, we need your business, right? So that's a risk there. And then that debt to equity ratio, this is going to tell us how that mix is. Do we have more liabilities or do we have more equity? And you can see how companies are financed. Generally, companies are financed with more equity, right? You generally want to have more equity than debt. So you'd want this to be over 1. And then times interest earned. This is going to tell us how much income we have before interest and expenses over interest expense. And so this is where, from a personal finance perspective, right? If you're spending more on interest than you make, then you're in trouble, right? And same thing with companies. So we're going to take income before interest and taxes. We'll take the net income plus interest expense plus income taxes equals income before interest and taxes. Oh, this is. Oh yeah, we take our net income and we add back interest expense and income taxes. That's what we're trying to say here. And then, so we're saying total income and then divide it by our interest expense. So how much are we paying as a percent of interest? So we might say, let's say I'm making $100,000 a year take home. That'd be nice, right? That's a good amount of money. But what if my interest expense is 50,000? Then so I take 100,000. You add back in your interest expense, divide it by the 50,000. And so that's how I'd get my I'd get a 3 times interest earned. So it means every year I make 3 times what my interest costs me, or or my interest expense was. Same thing, a company could do this. If you get less than 1, your company is in significant trouble. It means you can't afford your interest payments. Same thing personally. You could do this with your personal finances. And if your interest expense is higher than your income, you're probably in financial jeopardy, and you would need to work with a debt consolidator at that point.